Next speaker is Tim Johansen, and he comes from a company called Qualitas. Please welcome him.
Normally not happy about this, but today I'm happy I've got no hair, so thanks for that. Nice segue. Good afternoon, everybody. Apologise in advance of my voice. It's a little bit husky, just carrying a cold. Today I'm going to talk about the Qualitas Real Estate Income Fund. And just a little bit of history for those who don't know. Qualitas is a real estate investment manager. What that essentially means is we manage capital on behalf of global and domestic institutions, sovereign funds, pension funds, insurance companies, etc. And we also manage capital on behalf of private individuals. So we have about $2.3 billion under management. That's broadly our business, and we obviously have a listed fund that we floated last year, which I'll talk about today. In regards to the Qualitas Income Fund, we listed late November last year. We raised $231 million of capital. At the end of June this year, we did a placement for 15% of that. So that income fund now it has about $265 million approximately of capital that it has to deploy into transactions. I mean, essentially, the fund is a yield fund. Our target return is 8%. It's all about monthly income pay, it's about capital preservation, and it's about diversification. There are three platforms of what we're trying to achieve in this particular fund. So just our thesis, and this was our thesis when we decided to list this fund last year, and it's all about the commercial real estate debt market. So what that is really loans that banks make to owners of real estate. It could be an industrial property, it could be a commercial property, it could be for development, it could be a piece of land, it could be a hotel. So essentially that market is about a $280 billion market in Australia. And the banks probably have about 85% of that market. So they're very dominant. It's very different here to how it is in the US and the UK. There's a lot of private lenders, alternate lenders like Qualitas who contribute quite a significant market share to that Englobo market, if you like. So here we're very dominated by the banks. Our view for a number of years has been that is going to change and that the banks are going to gradually lose market share and you have the alternate lenders come into the market and take some of that market share. So that's what's happening at the moment. And there's a few reasons why that is happening. Firstly, you've got APRA, who is the regulator of the banks, who has been very tight on the banks in recent years in terms of how they're structured, their capital base, etc., what types of loans they're doing, their exposures to real estate. So the banks have generally been pulling back their exposure to real estate transactions. There's regulation globally of the banks through the Basel Accord, and that means banks have to have more capital on their balance sheets, which means they have to be very careful and sparingly how they use that capital and how they price that capital. And the Royal Commission, which you'd all have read about, the banks and insurance companies, etc., have been under the spotlight for some time about their practices. And so the banks have been generally inwardly focused as opposed to externally focused. So that means a little bit off their game, if you like, and that's opened up the opportunity for groups like Qualitas to reach into that market and take some of that market share. We think the alternate sector may take sort of circa 10+% of that market. So that's around $30 billion of transactions that are available to groups to do. And obviously the QRI, our income fund, is a direct beneficiary of those types of loans. We still, despite, and you've heard it just now about how the economy's going, etc., it is tough. Interest rates are low for a reason. It is tough out there. In terms of real estate and what we look at, we also look at population growth. And Australia still sees good population growth. Sydney gets 100,000 people a year. Melbourne maybe 110,000, 115,000 people a year. That's a lot of dwellings that you need to keep building to house that population growth. The average formation of a household is about 2.5 people. So 100,000 people coming into net growth of population in Sydney of 100,000 mathematically equates to 40,000 dwellings. Now, we have got to a peak of actually building those. We've done a lot less as well, but you can see that we do need to keep building. Obviously, low interest rates as well. So, we're getting very low at the moment, historically low. So it means people can afford themselves with greater levels of debt or access debt more easily to do things. So there's a few things that support our market which we're happy with, but balancing that with how the performance of the economy is generally. So typically the types of deals that the income fund will do, and generally what we do in our business as a whole, is we finance the acquisition or the refinance of property or real estate built form. That could be for land, that could be a development site, for instance, close to Sydney, in Sydney's, for those of you mostly probably from Sydney, in a city, within 10 or 15 Ks of the CBD, so stick to the core market, stick to the markets that are less volatile. So we may finance a site at, a 50% gearing level as an example for a strong developer who has 10, 20 years experience, good balance sheet, personal guarantees, etc. We do some construction financing, so we actually finance the construction of apartments. We've been doing that for 11 years at Qualitas, and many of us have worked elsewhere for a lot longer doing that type of financing. And investment loans, that's simply where somebody buys an industrial property or a commercial property, office building, hotel, where there's actually income coming off that property, and we just finance that. Very sort of a lower risk type lending style over, say, a construction deal which has higher risk, and maybe land as well. The portfolio up there is on the right-hand side of how we've constructed it. So these numbers on this slide are at the end of June. I'll just point out that we did release our July results to the stock exchange this morning. So you can see the pie graph there that sort of shows the split of loans in the portfolio. I'm sorry. Thank you. So this sort of demonstrates the capital stack of a transaction, just to explain what we do. So when somebody buys for the simplicity of numbers, if they buy an office building for $100 million, they will borrow, for instance, $60 million from a lender, and they put $40 million in themselves. So that's their equity contribution is 40, and the loan amount is 60. So that's essentially what we do, is we look at that debt piece. When we launched the fund, we said that we would do senior loans. That means you have the benefit of a first mortgage, and we would do selectively some mezzanine loans. That's where you have a second ranking mortgage and you sit. So on that diagram, we said we'd do mezzanine loans from 65 to 75 and up to 65 on senior. And the equities is the top piece. This fund does not do the equity piece. It's really where we have security over the real property assets. Probably a theme in our fund since we listed late November is that when we started the fund, we'd said we'd do mezzanine loans, which are higher risk. What's actually happened is we've done less of those mezzanine loans. We've seen some, we've done a couple, but we've really decided not to do some of those because we think some of those are high risk in the current market. So the construct of our portfolio, we've been very conservative, and we've built it progressively to be more conservative than probably we set out, and we think that's appropriate in this current market. So it's more dominated by senior loans, first ranking positions, doesn't have as many mezzanine loans as we anticipated. We've been doing this for 11 years. We're very experienced at what we do. We have 70 plus people in the business. Maybe 24 of those people are responsible for finding these deals, managing them, developing the relationships, and asset managing them along the way through. So we have a very strong approach to our risk management. We think this is attractive to retail investors because normally retail investors would not have access to these types of loans. It's really for the domain of the wholesale investors. So we think this is quite attractive given its stable monthly cash flow. So it's a trust, so we distribute every month the income in that fund. We try to achieve a very diversified portfolio by asset type, by client type, and by geography, and really focus around capital preservation. So how this works is really, the money that's in the income fund is used by Qualitas to lend into transactions. It's as simple as that. And the income that comes out of those transactions, so the rent that comes from properties, is passed through the manager to the unit holders. So it's a pass-through. So every month we distribute that income that's accumulated during the month, pay that out, and just leave a reserve, a little bit of cash left in the account, essentially just for, to have a bit of a buffer, but largely it's all passed through. As I said, our role as Qualitas is to find these opportunities. The real estate game is very much a relationship business, so many of our clients we've had relationships with personally and in businesses for 15, 20 years, so they're very deep relationships. We spend a lot of time assessing loans. We look at a lot of loans and we dismiss a lot and we do very few. So we're very discerning about what we take on and what loans we want to put into this particular fund. Loan management's really important to us. We don't just do these loans and forget about them. We sit down as a group every 6 weeks and go through every asset that we are involved in, and we work through that and reach an agreement between that committee that everything's running okay with that asset. I'd say today, I can say we have no impairments across our portfolio, across our whole business. It is a tougher market, so we're very vigilant on risk. But so far, and touch wood, our portfolio is very clean. Just the fund performance. So what this shows is since our listing in November, late November, this is the gradual ramp up as we've deployed capital. So every month on month, we find loans, we assess them, we approve them, and then we decide whether the loan is suitable for this income fund. So this shows the gradual ramp up. As I said, the July results came out this morning. So that 5.89 on the top right there, this morning was 6.23. So our target's 8. As I said, we've taken less risk in the portfolio than we set out to achieve. I suppose we've also had, effectively a 1% drop in the cash rate due to the RBA's moves. So that's affected our returns. But we're very happy with the gradual build of this portfolio. What's really important to us is the risk of the portfolio. We're not interested in taking high-yielding deals just to get the yield up and overperform, and for us to earn a performance fee at the risk of the transaction or the portfolio is higher risk. We're not interested in that. This is a gradual build. This is a key fund for our business, and we're going to gradually grow it as the market permits us to do so. This is our the trading performance since we listed. So we listed at $1.60. It really hasn't gone down past that. It's generally traded as high as $1.75 plus. So I think for us, we sort of try to read and understand why that is, and we think it's really around the attraction to how we've constructed the portfolio, the monthly pay, the diversity that it provides. So we hope for that to continue. We don't expect this to be a growth stock, a capital growth stock. It's not meant to be that. Loans don't do that. It's an income fund. A loan is a loan. You don't get capital growth on loans. This is about income. So if this had traded at $1.60 all the way through for 8 months, we would have been very happy. But for whatever reason, it's traded above. So I expect investors probably think they're happy with the yield that comes out of this portfolio. I've got a red light. My last point is bit of detail there, but you can see it on the side. Just shows the portfolio breakdown across the business. There's 27 loans in this portfolio, very diverse, and we think we're very happy with that portfolio split at the moment. And our management team is exactly the same as it was when we listed this fund late last year. Thanks very much.